Alrighty. So I believe we are live. Restream says we're live, so that's good enough for me. We're going to accept the word of Restream. Alrighty. So it is, fabulous. It is Tuesday at 6 p.m. And so it is time for Tech Sherpa Live. And I know it says office hours. Well, it's going to say office hours here in a second. I know it says office hours Q&A. We will have probably a little bit of Q&A towards the end, but we're actually going to do something a little bit special today, and we will see how it all shakes out. But let's just dive into it. My story, I came to the tax world backwards. So I got giant tax bills. I had letters from the IRS saying I owed them $1.3 million. I was like, well, that's not good. And so, like most people, I just ignored it and buried my head in the sand. And that went on for a couple of years. So if you've never been hounded by the IRS, here's how it works. First, you get letters. And then if you ignore those, you get certified mail letters. And if you ignore those, you'll get phone calls. And if you ignore those, they will start going after whatever they can find. So in my case, I didn't have any boats. I didn't have any large bank accounts, but I did have a W-2 at the time. And so they started garnishing my wages. And I was like, well, I actually have to fix my problems now. So I ended up in that process of fixing my own problems. I found the guy who eventually became my mentor. He's a former Wall Street tax attorney, and went from owing $1.3 million to zero. And that whole process took about a year. And in the process of doing that, I found his business was starting to grow. I had took my 10 plus years of entrepreneurial experience and started applying them to his business. We tripled uh, his business over the next couple of years. And he taught me how a Wall Street tax guy thinks about tax returns, which I didn't know at the time, but was entirely different than how most people think about tax returns. So it's one of those things. Like you get used to whatever you're used to, and you don't know that the entire industry doesn't do this. But I found that out over the years that the entire industry does not do this. So since 2011, worked on over 50,000 tax returns on billions of dollars worth of client revenue, and we save millions of dollars every year, which is great. So in 2019, but really good start in 2020, I founded Tax Sherpa, and our mission here is to help my tribe, the solopreneurs, the independent contractors, the small business owners, get their quality of life back by saving on their taxes. Because here's the thing about taxes is that you are not only an unpaid employee, but you are paying to be an employee of the government whenever you pay taxes. So you go to work, you do whatever it is you do. Maybe you work for somebody else, maybe you have your own gig, maybe you have a small business, whatever it is. You go out there, you do economic activity, you get money, and you hand over a portion of that money to the government. So if your tax bill is 30%, let's say, when you add up all the different things, it's 30%. That means 30% of your year was spent in labor for the government. And I think that is all kinds of bad. I think it's morally wrong. I think it's economically wrong. And I think it's just not what we want to do. So we want to minimize that as much as possible. So if we take you from 30% to 15% or 35 to 15 or, whatever the numbers end up being, those are days of your life that you're getting back every single year. And, what you do with that time is up to you. Some people reinvest in their business. Some people will go to Vegas. Some people will, spend time with their family, whatever it is. Whatever you choose is going to be a better value than whatever the government would have done with your money. At least that's my opinion on it. And Serena and I had a meeting with a guy earlier
Mhm.
today, talking about tax strategy. And he was saying, I'm not going to get political, but, it's government spending. And it's like, yeah, the great thing about government spending is that no matter where you are on the political spectrum, I guarantee you the government is spending a lot of money in ways you disagree with, just because they spend money on everything. So let's take your money back out of their pockets and put it back into yours. And that's the whole idea. Take control of your life. This is a quote that I love. I read it every week. The quality of our questions determines the quality of our life. And I think that is 100% true. Uh, It's attributed to Tony Robbins. I'm not sure he came up with it or not, but it's a good quote. So my question is, what's the root problem with that? And I kind of went into this already, but the root problem is that you're wasting 74 days every year. That's an average. Yours might be higher, might be lower, but 20% of your life that is spent working, laboring on behalf of the government. And that's 74 days too many. Now, we do live in a society where you're probably going to pay some level of tax. There's all kinds of taxes that people forget about. There's income taxes, there's sales taxes, there's property taxes, there's excise taxes, and the list goes on and on. There's Social Security, there's Medicare, all kinds of stuff, and we want to shrink that as much as possible. And some of that we have control over, some of that we don't. But how does that the 12-step prayer go? The power to change what I can change, and the acceptance to or I cannot remember how it goes. But being able to change what you can change and knowing the difference between what you can and can't change. That's kind of the basic idea. And I think that's a good, whether you're in AA or not, I think it's a good motto. So I know people have questions, but the answer to all tax questions is it depends. And it really does depend. So what I wanted to do this week was a little bit different than what we usually do. And what we're going to do is we're going to kind of walk through the building blocks of a tax plan and how it is that we can adjust things so that people pay less in tax. So Serena has picked out somebody. I don't know who it is. I don't know anything. And she's going to give me the facts of the case. And we're going to just kind of work through how it all shapes up. So I like to do a lot of my mapping in a flowchart software. This is what's called Lucid. I mean, you can use whatever, but this is just the one that I like. So Serena, why don't you tell me what it is we have going on
Okay,
in this
so
case?
we have a client that's in Florida,
Uh-huh.
and he is making 1099 income
Okay.
uh, of 200,000,
Okay. Pretty good.
and it's a S corp.
So the 1099 is going to the S corp.
Yep, coming from
Oh,
the S corp,
okay.
and he also takes a salary for 90,000 from the S corp.
Okay. 90K. All right.
All right, he's married
Okay.
with three kids,
How old are the kids?
8, 10, and 15,
Okay.
and he also has property.
He's got property, like investment property.
Yep, rental properties.
Okay.
So there's three properties. The first property, and they're all in Florida.
Okay.
So the first one, it's owned by three members,
The first
and
first property is owned by three members.
mhm, LLC.
Okay. And he's one of the three.
Yep, he's one of the three.
Okay.
And his K1 from that property is 7,000.
Okay.
The second property, he's 50% owner,
Another LLC.
another LLC, and his portion of it is 10,200.
Okay.
So he makes $10,200.
Gotcha.
And then the last property, he generates 41,000, and it's owned by him and his wife.
Um, it generates how much?
41,000.
Okay. And so that's the gross. Do you know what the net is?
So that's the net,
Oh, that's the net.
Mhm.
Okay. That must be an Airbnb or something. That kind
Yep,
of cash flow.
Airbnb.
Okay. And I just saw in the chat here, David just got told I owe 5K in income tax. I want to throw up. They've already taken tens of thousands. Yeah. David, what you should do is send an email to office@taxsherpa.com, and we can take a look at it. No obligation or anything. And uh, sometimes those notices are right, sometimes they're wrong. We had a case a couple weeks ago with a guy who had forgotten to give us a brokerage statement, and he got a letter from the IRS to say, "Hey, you didn't include this income. You owe us $7,000." And we said, "Okay, well, send us the brokerage statement for the stocks that you sold." because it was just an account he'd forgotten about. And, all right, whatever. And so when we actually went through it, um, the this gets a little technical, but like the basis wasn't reported to the IRS because it was employee stock. And so when all was said and done, we actually got him a refund because he actually ended up with a net loss on those stock sales. So those notices are not always right. So you definitely have it checked out. And we can take a look at it for you for no obligation, no cost or anything. And then if we do work, obviously then there is cost. But but just for looking, um, our accountant died. Yeah. That we get a few of those every year. It's like my old guy died and I don't know what's going on. And we had one case a number of years ago where a former accountant had died. She had thought the accountant had filed the taxes. It turned out he didn't, and it was just a cluster of mess. Um, so yeah, that's tough. But like I said, just email office at Tax Sherpa. We can take a look at it for you. All right. Um, all right. So anything else, Serena, that you would add to the case here?
Nope, that's it.
Okay. So all right. So here's what we got. So basically, we start with a 1040, and this is married, filing joint. And oh, does the wife make any income?
No income.
Okay. So then we've got LLC one. This is probably going to be a 1065. It's usually how they're set up. And then there's LLC two, 1065. That's property one, property two, and then property three, the one that's owned by him and his wife, is that in an LLC or no?
Nope, no LLC.
Okay. So this is going to go through what's called Schedule E. And then oops. This is actually going to go through Schedule E as well. All right, and this was 41. Okay, let's zoom in a little bit here. This one was 10.2. This one was 7,000. One in there. Oh, come on. There we go. Okay. And that's going to go into there. Okay. So then we've got this other thing over here. We've got his 1120S. And we've got revenue coming in. And this is 200K. And then he's got a W-2 of, what was it, 90? Yeah,
Yep.
90K. And just for those who are tuning in at home, when you have a profitable company that's an S corporation, you do need to have a salary in order to pay in some Social Security tax. There's a lot of considerations that go into how much the salary should be and how we want to optimize that, but it's there. Okay. So so normally we're going to have, operations expense. And normally in small business, service business, and everything, you're normally looking at like 15 to 20% of the revenue is what it costs between like advertising and software and service fulfillment and all this kind of stuff. So if we've got 20K here, I'm going to assume that there's 40K there in operations expense. And that means that 200 minus 40 is 160, 90 of which is W2. And so that means the distribution portions are going to be distribution are going to be here. Let's do it this way. So that's going to be 160. So it's going to be 70K. Now I'm already running out of room. Let's move that over here. And so distributions from an S corp have a special feature called the qualified business income deduction. And so that's going to be, let's see, we're married filing joint, so that's going to be underneath the threshold here of 390,000 or something. And so we're going to get a 20% break on this. So that's going to be 14K. And then the rest is going to go in here. And that's going to be 70 minus 14 is 56. Okay. And then here we've got Social Security Medicare tax. And that is going to be 15.3% of 90, which is 90 times 1.53, which is 14 grand. Okay, so that leaves 76. Okay, come in here. Okay, so let's total it all up. So let's see AGI. We've got 90 plus 70 plus 41 plus 10 plus 7. So that's 218. So AGI is adjusted gross income. We're going to assume standard deduction is 29K this year. And then we have QBI of 14K. Okay, so taxable income is going to be minus 29 minus 14 is 175. Okay, so let's do a little bit of bracket math. Tax brackets. And 2024. Married filing joint, taxable income was 175. So he's going to be in the 22% bracket. So already he's in the one of the lower brackets, and that's its advantage because he's married filing joint. And so that is going to total up to what? 94, 300. Okay. So 94, 300 minus 23, 201 times 12 plus 200 times 0.1 plus, that's already 10 grand. And then there's like 5,000 minus 94.1 times 0.22. So that's 28,605. Income tax, 28,605. And then Social Security med tax is 14K. So total tax is, was that 42.6K? You know, I'm rounding here just to make it a little bit quicker. So this is kind of our starting point. All right. And this is how we diagnose. We kind of do, this is what we call the survey, where we get the client's information and we survey the land. We say, okay, from here, where can we go? What's our route going to be? And so what we're going to do is I'm just going to duplicate this whole thing and move it over here. Okay, so things we might do. So we're definitely going to adjust stuff. So let's get rid of these numbers. So that's going to be getting rid of, getting rid of, getting rid of. And so these properties over here are outside of our control. They're inside of partnerships, and anytime you're dealing with partnerships, it's always a fight because the ownership incentives are not always in alignment. So we've seen many, many partnerships where, you know, owner or partner number one says, I want to pay as little taxes as possible. And partner number two says, yeah, I hear you, but I need to buy a house. So I need to show more income in order to qualify for the mortgage that I want. And, you know, then it's an argument, right? So normally what we want to do is we want to put all partnerships into a management structure. So instead of these going just being owned individually, what we're going to do is we're going to put these over here. And they're going to flow through. They're still going to be real estate income, but we're just giving ourselves more flexibility. All right, so that's thing number one. Thing number two, property number three is not in a company. And, you know, there are pros and cons to that. So, con number one is just liability. If somebody slips and falls, they sue you individually. That's not something you want to deal with. So, generally, even if you are holding it personally, like through a transparent LLC, uh, still having it titled in the LLC is going to be better just to give you that liability protection. I'm not a lawyer, but that's my understanding of basic law stuff. So the wife doesn't work. So one possibility is that we do a cost segregation on this property. And in order for that to be beneficial, well, actually, that's not even necessarily the case. So cost segregation is a strategy where whenever you have an investment property, you don't just have a building, right? You have a building, you have cabinets, you have driveways, you have uh, landscaping, you have cabinetry, you have wiring. And what a cost segregation study does is they go into your property and they analyze all those different things and they break apart the different types of property because those all have different write-off schedules. So a residential building has a 27 and a half year depreciation schedule, which roughly works out to 4% a year. And so if you have $100,000 building, it's going to be $4,000 a year worth of write-offs just for owning the building and the wear and tear on it. But if you segregate those different things into different categories, most of the time what we'll see is we'll get about 15% of whatever that purchase price was segregated into the shorter term property. And that accelerates your deductions in the first year and lessens them in the years after that. So that is worth noting. So if you plan to sell the property soon within the next couple of years, it's probably not worth doing. If you plan on holding it for a long time as rental, generally is worth doing. There are caveats though, and this is part of the subtlety that goes into tax planning. It's like, well, one, can you use the deduction? Because real estate by its nature is considered passive. So um, what you want to do is you want to qualify as active, or you need enough income in order to absorb those losses. So I'm going to make a couple assumptions about property three here. Uh, so I'm going to assume that it's it's kind of an average house, which these days is about 400 grand, which is crazy, but that's where we are in society. And so I'm going to assume that cost seg is going to get us 50K worth of deductions. Okay, so now this turns from positive 41K into minus 10K because 50K went there into first year depreciation or current year depreciation. There's a couple different ways to do it. So that right there is going to save, 22% of 50 grand. And that's about 10 grand worth right there, worth of tax savings. Okay. We're moving these properties over here into the S Corp, and the numbers there are not going to change because again, they're outside of our control. What is going to change is our operating expenses because we're going to implement some additional strategies. Actually, I'm going to do it this way. So we're going to do some management meetings, and we're going to implement reimbursements because there's a lot of things that people end up paying for out of their personal funds that they don't realize can be elevated to the corporate level. And so I'm just going to take some kind of average numbers here. When we actually go through with an individual client, we would analyze these more in depth, but I'm just, okay, taking averages. Let's say 15K there, and let's say 15K there. Okay, so these become tax-free expenses that still come home. And what we're doing here is there's a million different kinds of tax plannings. There's a million different kinds of strategies. But the strategies we're focused on here are what we call cash flow neutral, meaning you have the same income, you have the same expenses. We are just characterizing them in a more efficient way. And so, there are other things where you could, you have to pay out of pocket in order to realize a tax advantage. Like, for example, you could always add an IRA in, and that's $7,000 that you can put in. That's a deduction against current income, and that's going to save you. If you're in the 22% bracket, it's going to save you 22% of 7,000. But you still got to put the 7,000 in the account. So it's not a free lunch. So what we're focused on here is the things that we can control in order to um, take the same pieces we already have and just reduce the tax load. I hope that makes sense. Um, so yeah, so we got 200 coming in, we got 40 going out in OpEx, we got this 10 and 7, we got 15 and 15 there. So what does that actually leave? So the 10 and the 7 here are still going to flow through on what's called box 2 income, which is real estate. So that's not going to interact with this stuff because this is going to be operations income, which is box 1. Probably more detail than you need at the moment, but I just want to let you know that these numbers are still going to carry through in the distributions, basically. Okay, so we got 200 coming in, 40 going out. So that leaves us with 160. We're getting another 30 in management meetings and reimbursements. So that brings us down to 130. And now out the 130, how do we want to segregate these into W2 versus distributions? Well, the real answer is you got to look at what they're actually doing. But a good starting point is just kind of half and half. So we could say, take 65 there, and then we get ER retirement of, let's see, that's 65, so we can get a quarter of that. So 65 times 0.25 is 16. So this is a retirement plan that the employer contributes to. So, I said that I was talking about IRAs. This money becomes like this somewhat of a free lunch because it's going to be paid for by the tax savings, and we get to reduce the overall income. So that's going to be 16K. So now that leaves 49K going for distributions. And then we're going to get QBI treatment on that of 10. And that leaves 39 through there. So now, and Social Security Medicare tax. Let's see, 65. That's going to be 10. Okay, so let's see what kind of numbers we're dealing with now. Standard deduction is going to remain the same. QBI drops to 10. All right, so AGI is going to be, let's see, 65 plus 49 plus 7 plus 10 minus 10 from the cost seg here. So 121. I don't know if you can see my calculator or not, but so we went from AGI of 218 to an AGI of 121. See that?
Yep.
And that's by implementing all these things. So that's just off the bat. That's going to be a huge difference. Still gets a $29,000 standard deduction. QBI is going to be 10 grand. And so minus 29, minus 10. So taxable income is 82. All right, we go back to our brackets. So we've actually dropped down to the 12% bracket. So income tax is going to be, let's see, 82, 82 minus 23 times 12 plus 2.3. So it's be 9.3K in tax. Social Security Medicare tax is 10 grand. And so total tax is going to be 19, 300. Again, I'm rounding, but we're in the ballpark. So we went from 42 to 19.3. So what is that? 42 minus 19.3. So that's a $22,000 savings.
Pretty good.
And at the same time, we put 16 grand into the retirement. So the 22, you can see, this is what I mean by paying for it. 22 is more than the 16. And so if you didn't want to do the retirement, you don't have to. But it's a freebie, essentially. Other things that we could do is, we've got 3 kids. We could put them on the payroll. For that, it would have to get a little more complicated. We would need another entity over here. And then we could put the kids on payroll. And between the 3 of them, given their ages of 8, 10, 15, we could probably get 25 grand out of that. So now do it like this. So we'll take 25 grand there. And that will actually decrease this even more. Probably should have done this first, but I didn't think about it until now. That's probably doing things live. All right, so we got 200 coming in, minus 40, minus 15, minus 15, minus 25. So that leaves 105. So now, again, just ballparking at half. We're going 15 there, 12 there. And so that leaves 43 here. 43 times 0.2 is 8. And that leaves 35 there. And we reduce our Social Security tax to 7. Okay, so now what do we deal with? We got 50 plus 43 plus 7 plus 10 minus 10. So now we're down to 100. Standard deduction, 8. Taxable income, minus 8, 63. Again, in the 12% bracket. So 63 minus 23 times 0.12 plus 2.3. So that's $7,000. And so we just saved an extra 5 grand by putting the kids on payroll.
Pretty good.
And the ratios here on the savings and the employer retirement contribution got even more extreme. So it's even more of a freebie to do that one. And so, yeah, I mean, this is kind of how we map stuff out. Now, again, these are, based on the facts that Serena gave me, this is kind of a generality, but we're going to be close. Everybody's specific situation is going to be different. Your specific numbers are going to be different, but this is kind of a good first approximation, let's say. And again, all cash flow neutral. So the objection that I get from clients is mostly on this part right here. It's on the kids' payroll. Because they say, I don't want to pay my kids. Do I have to pay my kids? Do I actually have to give them the money? And the answer is, yeah, they got to do
Yes.
actual work. You got to
Right.
actually pay them. You got to actually file the forms. So, there are provisions that, provided for by Congress and enforced by the IRS that if you have family employees and the employees are children between the ages of 8 and 17, and the owners of the company are, and it's a partnership, and the owners are all parents of the kids that are employed, then those payments are exempt from Social Security tax, they're exempt from Medicare tax, and they're exempt from federal unemployment tax. In most states, they're also exempt from state unemployment tax. And so if you pay them less than the standard deduction, which this year is going to be 14.8, then they're also underneath the level at which they need to pay income tax. So it's completely tax-free as for paying them. And whatever entity is paying them gets to deduct those as a wage expense because it clearly is. So um, that's the advantage. But then that does not solve the objection of I don't want to pay my kids. So
Right.
the the real thing you got to realize is that you're already paying your kids, right? You are like my kids are at a swim team meeting right now, and they're going to be there until 10 o'clock, and we are paying I don't even know what 1,500 bucks for the summer for them to be on the swim team, something like that. And then we got to join the pool. That's 600 bucks a month. It's it never ends, right? There's school and there's camps and there's if you're extra curricular activities, there's clothes, there's food, just the list of expenses go on and on and on. So the difference now is that when you put the kids on payroll, they're going to pay for their own stuff, or more accurately, you're going to pay for their stuff with their money because you're going to be the signatory on the account because they're still minors. So you just get a new debit card and use that. And when it comes to it's like, oh, mommy, daddy, I want this, I want that. I was like, okay, well, here's how much you have in your bank account. Let's go use it. And all of a sudden it's like, oh, whoa, 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 let's think about this, because the kids will get a lot more frugal once it's their own money. So and there's all kinds of great things you can do when you put the kids on payroll. Now, if you want to get even more aggressive, there is that once the kids have earned income, they have W-2, they're eligible to contribute to IRAs. So you could take that money and have them contribute to either a Roth IRA, which has no tax deduction, or a traditional IRA, which does have a tax deduction. So again, they have to do actual work, and you got to look up, comparable rates and all this kind of stuff to justify the salary. But if they can do stuff, then great. So like the 8-year-old, normally you're going to be doing kind of basic things, cleaning up around the office, janitorial stuff, things like that. The 15-year-old is way more capable, and a job I recommend for a lot of teenagers is social media management. This is a real job that has real value and requires real skill, and your kids are better at it than you are. So, uh, have them run your social media, have them do research on your competition, have them scope out um, potential clients, do all that social media work, and pay them accordingly. Pay them an hourly rate. Depending on where you are, I've seen that job kind of average out at like $16 an hour, all the way up to like $45 an hour, depending on the level and the geographic location. So, I mean, you can rack up serious payroll expenses there by doing that. And then, so you pay them that, and then you have them contribute to an IRA. And let's take the 15-year-old, for example. So if you start investing at 15 years old, um, and you invest $7,000 a year, which is the IRA contribution maximum, and you let that sit until you're 65, that's 50 years of growth. So, you know, um, I created so let me just go to my own blog because I forgot where I put it. Let's see. Hire your kids. Family help, yada, yada, yada. Salary.com. Mission 598. Oh, I haven't published it yet. Okay. Sneak peek. There is a new article that's going to be coming at some point that is going to go over the math of how you can make your kids millionaires for free by taking the tax savings and applying that to the IRAs for the kids and letting that grow for 40, 50 years. And the math is just amazing, assuming that the stock market continues to be a thing, or you can always set them up with a self-directed IRA and have them invest in real estate or companies or whatever. Um, there's lots of power to do that, but it all starts with taking the same money that you have coming in, the same money you have going out, structuring it better, and saving yourself $27,000 in the process. So that is one of the ways we do it. Other things that could be done, that are not cash flow neutral. We could, look at whether the wife can qualify as an active participant in the real estate, or if she can possibly be a real estate professional. if she's putting enough time into the properties. And then, you can start to look at cost segregation as a recurring strategy rather than a one time. And what I mean by that is if you buy a property, let's say you buy one property a year, and you you take the cost segregation of it and apply it against your other income. And then, depends on the numbers, but you could easily turn that into buying a property, making positive cash flow, and saving on taxes all at the same time. And you might save, 20 grand on a cost segregation study if the numbers are right for your particular situation. Now, this particular situation probably not going to be that high because we're already fairly low income. Low is all relative there, but you're in the 12% bracket is what it comes down to. So, every dollar you save in deductions is going to get you back 12 cents. If you're starting off in the 35% bracket, then you're getting back 35 cents for every dollar you save. So you have more bang for your buck at that point. And this is why a lot of people feel like tax strategies don't apply to them. It's like, oh, I don't make enough. And that's kind of what they have in their heads, that like, I don't make enough for these things to pay for themselves. And I can tell you that no matter what your income is, they do. So you might not make as much on a tax strategy. You might not have as much tax savings as somebody who has a higher income. That part's true, but it's still going to be dollars in your pocket for sure. So it's just a matter of analyzing your situation and figuring out where things can go. So, but cost segregation as a recurring strategy, let's say let's say you buy a property, you do a cost segregation study, you make positive cash flow, and you could get tax savings all at the same time. And so just picking numbers, you save 20 grand on taxes and you make 5 grand on actually rental income, after all your expenses. So that's a net $25,000 in your pocket by doing that. So that $25,000 becomes a down payment on your next property. And then you do the cost segregation on that property, generate another $25,000. And that becomes cost segregation or the down payment on the next property. And you can just roll this over and over and over again as you build out your real estate empire, if that's something you want to do, if that's something interesting. And by just by the fact that this guy has interest in 3 different properties, obviously they like real estate, so that could be a potential path for them. But that is not what we call cash flow neutral because it does require putting money down into a property, right? And that can be a good or a bad investment, hopefully a good one. But it's just an extra layer on this type of strategy. Other things you could do, like so we could do the IRAs. We could take there's $50,000 of W-2 here. We could actually take up to 23,000 of that and put it into the same retirement plan over here, but from the employee side. And that would save, let's see, 12% of 23,000 is going to be what? I had a professor in college that says never do algebra in public. So that would save an extra $3,000 in taxes, but that would require putting $23,000 into that retirement plan. So, it depends on whether that's a priority for you or not. And some people, yes, some people don't. It becomes very subjective at that point. It's like, the older clients tend to want to put money into retirement, and the younger clients tend to want to keep the money in their pocket. And that's, available for spending. So, there's definitely a life cycle element to how important retirement plans are to most people. But yeah, so our AGI here is 100,000, but how much is the actual cash in your pocket? So, that's a different number. So let's say cash in pocket. We're going to have, so the 41,000 from this property is still being generated. We're just taking advantage of the cost segregation study to reduce the taxable impact of it. So it's going to be 41 there, plus 43 from the W-2, because the Social Security tax you do have to pay. So that's going to be 50 minus 7. So that's going to be 43, plus the 43 from the distributions. Even though 8 goes to the QBI, you still get that money. Plus the 15, and then plus the 25 going to the kids because you're spending that money anyway. And that total is, let's see, 41, 43, 43, 15, 15, 25. So that totals 182. Okay. So cash in pocket is $82,000 higher than the taxable income. And
Pretty good.
that's just all this recharacterizing. And that's where the tax savings comes from, is that we're able to move those numbers around. Oh, and you get the six and or the 12,000 and in the retirement.
So Neil,
Um,
that means that is so you're not donating that money to the government, right?
exactly.
That's what's important here. Very important.
That is the whole thing. So net, you're up a lot. And this is this is kind of average for what we do. So when we talk about how we save clients 20, 30, 40, $50,000, this is like all the time, if that makes sense. Now, granted, you do need a certain amount of income for that to make that work. So this guy is bringing in 200, and I assumed he's spending 40, so that's 160 really of of income. And so that's higher than your average American. I think the average household income right now is 84 or something like that. But that's the whole spectrum, right? So that includes your part-time workers, working retail or whatever, and that includes your billionaires, right? So um, if you are working for yourself, and you're doing your own, you have your own gig, or you have a small business, which is the people that we typically work with, then this is kind of in the realm of normal, plus or minus. And then as you make more things become available in the sense of you know uh the things where you have to put down money in order to get a tax savings, those start to make more sense. But these kind of strategies work for everybody because they're cash flow neutral, and that's really the key to the whole thing. Um, so yeah, that's kind of an insight into what it is we do, and I hope that makes sense to everybody. Serena, did you have anything in mind that we didn't cover for this particular case?
No,
Nope.
everything looks good here. I do have a question from a client.
Okay. Well, let's go to the
Um,
questions then, because the answer is
yes,
it
yes.
depends.
All right, it depends.
And you can start to see what it depends on. It's like, well, I've got income coming here, I've got a W-2, I got these properties, I got these kids, I'm married, she's not working. That's the kind of stuff it depends on. So I hope that starts to make sense. Because I say that and people just kind of roll their eyes. It's like, no, really, it does depend.
Understood.
So, so what is the question that you have?
So a client wants to know what are the qualifications to be able to do a cost seg report?
Aha. So cost segregation.
Mm-hmm.
Um, so we talked about what cost segregation is already, but in order for whether or not you can use it, whether it's useful to you or not, is going to depend on a couple different factors. So one is the property profitable on a tax basis or not? So this one was. It's $41,000 net. And if you have profit, then that suggests cost segregation will be useful just automatically. Because what happens is, if the real estate is running at a loss on a tax basis because of that depreciation that you already have, then it becomes more of a question as to whether cost segregation is useful or not. Because, like I said, real estate is passive by default. So, if you are passive, and your income is less than $100,000, you can take up to $25,000 of passive activity losses. That's the PAL, PAL. Um, if as you make more money above 100,000, the amount of passive activity losses you're allowed to take shrinks and shrinks and shrinks. And once your income reaches $150,000, that passive activity loss goes to zero. And any losses that you have at that point just roll over to next year and rolls over to next year and rolls over and rolls over until either your income is low enough to be able to use it or until you sell the property, and those losses will reduce whatever gain you might have made. So the way around that is to convert it from a passive activity to an active activity. And there's different ways to do that. So one way to do that is to operate the rental property as a hospitality business. And that means having an average stay of under 7 days. So at that point, you're no longer operating a passive rental, you're actually operating a hotel. And that's the way the tax code looks at it. So if it's under 7 days, it's automatically active. If it's over 7 days, you can still make it active if you have enough time into it. And there's three different time tests that go into it that apply to most people. There are actually more, but most of those just never come up. So one is you can be active if you spend 100 hours a year on a property and you are the single individual who spends the most time. So there's no property manager that spends more time than you. There's no handyman that spends more time than you. You are the single person dealing the most with that property. And that total is at least 100 hours. Um, Second test is you can be active is if you put in 500 hours and whether you're the most or not the most doesn't matter. So that can work. Or at 750 hours of real estate activities, you can be professional. So 750 is more than 500. So why would you ever do the 750? Well, the 750 allows for more things. So the real estate activities covered in the 750 could be mortgage brokering, could be real estate agenting, it could be a bunch of different things that are related to real estate that aren't just working on the property. The 500 is just working on the property. And then there are elections that you should make if you have multiple properties to treat them all as one. That's an important subtlety that a lot of people miss. And so if you qualify under one of those tests, we now convert the passive list from the you convert the passive activity into an active activity, and then cost segregation is always going to make sense, assuming you have other income to defray. So that's kind of how we step through it as far as whether it makes sense to do a cost segregation or not. We got a question: does living in one of the properties units have any effect? So yes and no. The one you're living in is not going to be a rental. So the rental portion is going to be the units that you do not live in. So you got to separate those things out. Hope that is clear enough.
Nia,
Uh,
really fast. Let me chime
yep,
in real fast.
yep.
Can you show them the diagram you made? I know we have about 8 minutes, but it's already
Uh,
done. I don't know. You can pull it.
yeah. So let me see if I can do this without like showing all my client stuff. So let's see. Um, da, 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 da. I made a flow chart in my flow chart thing. Ba, 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 ba. There it is. Okay, here we go. So basically, do you owe some tax? If no, cost segregation is not going to be useful. If yes, is it a long-term rental? If no, do you have a short-term rental? If it's short-term, yes, cost segregation is useful. If you don't have a long-term and you don't have a short-term, then you don't have a rental property, and cost segregation is not useful. So if you do have a long-term rental, you go over here. Can you qualify as a professional? If yes, cost segregation is useful. If no, can you qualify as active under the 500 test? If yes, cost segregation is useful. If no, can you qualify under the 100-hour test? Yes, cost segregation is useful. No, cost segregation is not useful. And that's kind of the flow chart of how we go through things. We've had clients come to us and say, "Hey, I did cost segregation. It's so great." And then we look at their stuff. It's like, "Yeah, but you didn't have any income." So, I mean, great, but it doesn't help you any. It's not going to save you on any taxes. And if you're dealing with like residential properties, like under like I think the number is 600,000, there are automated tools that you can use online that cost $400 to run a report. But if you're over that threshold, then you're talking about 5-10 grand to actually pay an engineering team to come out to your property and do the study and write up a report. So um, it's not always a great idea. But yeah, so you definitely want to do this kind of analysis before you do the cost segregation rather than afterwards. But yeah, I mean, we had a client last year. They bought, they were active real estate agents, and they had a bunch of income, and they bought two properties last year, very expensive properties. One was in California, and one was in the Gulf Coast of Texas. And they did cost segregation, and we were able to get huge write-offs because of the cost segregation because they were such expensive properties. And it's fantastic. So saved them, 100 grand on their taxes. So, constant degree should be extremely powerful if it applies to you in the right situation. Um, so yeah, that's kind of how it is. And as far as these hourly things, like how do I know if I have enough hours? You keep logs. That's how you do it. And just, it's like today I worked 3 hours dealing with the tenant, on XYZ property, and that just goes into a log. At the end of the year, you total up your numbers, and that's your number. And then we can see which of these things apply to you. So yeah, that's kind of the idea. And we are coming in on the end here. So let's wrap up as far as next steps. So here's the thing. You can go to taxsherpa.com, you can click on the link, book an appointment, and you'll talk with one of our tax experts. We'll go through the survey process of figuring out your situation. And then we will generate one of these for you. So that's all great. However, we there's a limited amount of time, and if you want to just get this done yourself, what we have done is we've put our templates together, the same templates that we use internally, and we've made them available to you. So you go to taxsherpa.com/templates, and you can get our master tax planning worksheets. And inside the worksheets, there's, I don't know, 15 different tabs, and each worksheet has a video. Is The wrong video for business projection template is attached to the Excel file. Okay, I'll have to check into that. But there are videos on each tab for maybe I'll put the wrong one in one of them. And then it'll guide you through the template as far as how to use it, like how to set up all these different things. You get the business-based camp tax guide, which is kind of the overall explanation of how this whole strategy works. And then you'll also get a tax filing checklist, how to avoid IRS red flags. And that's just making sure that things are correct that aren't going to automatically generate a letter for you from the IRS that you don't want to get. And so you can go to taxsherpa.com/templates. You get that all of that for $7, which is, I think, a pretty good deal. Less than a cup of coffee, as they say, which I don't actually know because I don't drink coffee, but that's what people say. I understand Starbucks is expensive. And then, every week we do these at Tuesdays, 6 p.m. Eastern. And tomorrow I will update that link, taxsherpa.com/live, to go to our next one, which I have not put on the calendar yet. But every week, 6 p.m., we'll do these. I do understand from our streaming people that Facebook is going to be implementing some new restrictions. So I'm not sure if we will be able to be live on Facebook or not, but LinkedIn will definitely work. And the taxsherpa.com/live will typically that'll take you to the LinkedIn page. And yeah, that's kind of where we're at. So if you want to save yourself 27 grand, then go to taxsherpa.com/templates and you can get your own and do it yourself. But if you want it done for you and having the expert guidance, then you can book a call with one of our tax experts to do a full-on survey and route for you. And just to wrap up, there's 4 steps to our whole tax process that I've developed after doing 50,000 plus tax returns. So the survey is figuring out where you are. The route is what we just did as far as figuring out where we can go. Then there's the trek. The trek is actually doing the thing. All these pieces take work. We got to set up, there's paperwork, we got to move things from one place to another. In this case, we got to put the kids on payroll. That requires setup. And then after all that is put into motion, then we got to make sure we're still going in the right direction. We got to do our compass checks. And that's going throughout the year, checking in every so often and figuring out, okay, are we still on track? Are you still making 200 grand? Are you still spending 40? Maybe the 200, you got a big project and now it's 250. Or maybe you thought you were making 200. It's like, it's actually looking like 140. So, we have to adjust throughout the year as more information comes in so that we keep things in line with expectations. The main thing is that at the end of the year, you want to know what's going on. You don't want any surprises after the end of the year and say, oh, I forgot about this, I forgot about that. We want to know, okay, we projected here, we ended up usually really close to our projections, and plus or minus, whatever, however many dollars. But that's the goal. You want to close the year with a sense of certainty about how much it is that you actually owe, or are getting refunds in some cases. And You just don't want to you don't want to feel like you're overpaying from a lack of planning. That's really what we want to eliminate. We want to make sure that you are paying as little as possible and that you are expecting that. Because if you get a huge refund, and we've had clients get $200,000 refunds, uh, it's not great. That means you gave the government a loan of $200,000 and for nothing basically. So you want to just be right in line. That's the goal. Um, all right, so it is 7 o'clock, so we're gonna stop it here, and at some point I'll put these recordings up. I'm way behind on that, but yeah. Any final thoughts, Serena?
If you care about your peace of mind, come see us. We
There
will
you go.
make sure you get that.
All right. So we'll be here, do it all again next week.
Yep.
This was kind of fun though. I like doing this live. Maybe we'll do that again. Maybe we'll do some just standard Q&A. I don't know. We'll find out. Tune in next week. We'll figure it out. And with that, we'll see you.
Alrighty.